Hi, my name is CH. I have worked as a managed investments product specialist in Singapore for over 15 years and would like to offer, through short video courses, the investments related knowledge that I have picked up throughout the years to anyone who is keen to learn more about investments. This video is part of a series of videos focusing on providing basic yet detailed knowledge on mutual funds for Singapore-based or Singapore-booked investors. In this video, we aim to cover the various types of mutual fund fees, which is probably one of the most popular topic for most retail investors when it comes to mutual funds investing. The fees and charges involved in mutual funds investing can be primarily classified in three categories. The first category are one-time transactional fees, meaning these are fees you pay once for each buy or sell transaction. These are normally charged by the distributor for their efforts involved in providing the transaction platform and associated services. Hence, the fund provider does not gain from these fees. The second category are ongoing fees that are charged by the fund. These are the necessary costs involved in the ongoing running of the fund, such as paying for the investment manager, the research team, and the relevant operational teams within the fund provider company. These fees are embedded within the fund NAV, which means that a fraction of the fees are deducted automatically every day when the fund calculates the NAV at the end of the day. Hence, investors of the fund do not need to make any additional payments for these fees. Ongoing fees are usually defined on per annum basis. The third category are one-time transactional fees for special or specific circumstances. These do not apply to most funds and exist for fund-specific reasons, which we will elaborate more in the subsequent slides. Let's go through each of these categories in more details. The first category, which is the one-time transactional fees, comes in two parts, that is, the buy transaction and the sell transaction. When buying a mutual fund, the transaction fee is commonly termed as upfront fee, or subscription fee, or initial charge, or front-end sales charge. As the name implies, this is a one-time fee charged with a buy transaction. The most common approach is to charge this on top of, or separate from, the intended investment amount into the fund, because this fee is collected by the distributor instead of the fund. As previously mentioned, these are fees for the distributor's efforts involved in providing the transaction platform and the associated services. Most mutual funds will indicate in their fund prospectus a permissible maximum subscription fee that a distributor can charge for the fund, which is typically 3% to 5%. However, most distributors today typically charge 0% to 2%. Do make some comparisons between distributors to ensure you are not being charged above the market norm. Given this is a transaction fee, in Singapore context, this is subject to the Goods and Services Tax, or GST. So, for example, if you would like to invest $100 into a mutual fund, and the distributor is charging you a 1% upfront fee, and the GST is 9%, you will need to pay $101.09 to the distributor. The distributor then takes the $1.09 before transferring $100 to the fund provider for the transaction. Some distributors allow investors to invest an amount inclusive of the fees involved. Using the same example, this means you would pay $100 to the distributor, following which the distributor will calculate and deduct $1.08 from that $100, then transfer the remaining $98.92 to the fund provider for the transaction. When selling a mutual fund, the transaction fee is commonly termed as redemption fee, or back-end sales charge, or contingent deferred sales charge, which is in short CDSC. Similar to subscription fees in a buy transaction, this is a one-time fee charged with a sell transaction, and the most common approach is to bundle this within the intended redemption amount from the fund. The distributor receives the gross redemption amount from the fund provider, then extracts out the redemption fees, then transfers the remaining net amount to the investor. Redemption fees and subscription fees are generally exclusive, as most countries' regulations mandate that distributors can only charge transaction fees on either the buy or sell transaction and not both. Therefore, fund providers typically create one share class with subscription fee clauses and another share class with redemption fee clauses. We usually see share classes with subscription fees in today's world, although there are occasions where share classes with redemption fees are still offered by distributors. Similar to subscription fees, the fund prospectus will also indicate a permissible maximum percentage that a distributor can charge for redemption fees. Also similar to subscription fees, in Singapore context, this is subject to GST. Redemption fees are always inclusive or part of the redemption amount. So for example, if you would like to redeem $100 worth of a fund investment, the distributor will receive the $100 from the fund provider after the redemption order is processed, and the distributor will deduct the relevant redemption fees plus GST from that $100, which calculates to $1.08, and finally transfer the remaining net amount, which is $98.92 to you. CDSC specifically has an additional time range associated to the validity of the fee. For example, a fund may charge a CDSC if the investor redeems the holdings within 2 years of investment. Some funds may charge a tiered CDSC, such as 2% within first year of investment, then 1% between first and second year, then 0% after 2 years. This is what the contingent means in the term CDSC. Similar to subscription fees, do make some comparisons between distributors to ensure you are not being charged above the market norm. The second category of fees are ongoing fees that are charged by a fund and comes in 3 main types. The first type is the management fee. This is the most common ongoing fee referred by investors, and as the name implies, this refers to the necessary costs involved in the ongoing running and management of the fund, such as paying for the investment manager, the research team, and the relevant operational teams within the fund provider company. Management fees for retail share classes typically range 0.5% to 1.5% for bond funds, 1% to 2% for equity funds, and sometimes up to 3% for funds in the other asset classes or with specialized strategies. In general, if a fund strategy requires more resources and effort to run, it will naturally charge more management fees. The ongoing fees are embedded within the fund NAV, which means that a fraction of the fees are deducted automatically every day when the fund calculates the NAV at the end of the day. Hence, investors of the fund do not need to make any additional payments for these fees. For example, if the fund has a 1% management fee, this means in simple terms that 1% divided by 365 days is deducted as part of the daily NAV calculation. Since management fees are in percentage terms, fund managers always aim to grow their fund size as large as practicable in order to obtain a high management fee amount. By practicable, we mean that the fund manager needs to ensure that the intended performance is not affected when the fund size becomes large. Most funds will have a target maximum fund size that the fund manager is comfortable to run, and will stop subscriptions when that fund size is reached. Now, within management fees, there is usually a portion that is carved out as trailer fees or rebate fees. Trailer fees are fees paid by the fund provider to the distributor for the distribution and marketing efforts. For example, the investment specialist providing recommendation and explaining details of a fund to you when you visit a bank, or a detailed fund analysis in a top 10 listing you see on an online investment portal. Trailer fees are typically present in retail share classes, and this is why management fees are higher for retail share classes compared to institutional share classes, even though they are referring to the same fund. For example, if a fund has a 1.5% management fee for its retail share class and 1% management fee for its institutional share class, you can think of it as 1% fees is needed to effectively manage the fund. The additional 0.5% in the retail share class can then be carved out by the fund provider to pay any distributors as a trailer fee. The exact trailer fees paid to distributors, however, are dependent on a legal document called distribution agreement that is established between the fund provider and the distributor. Continuing on the same example, the fund provider can come to terms to pay one distributor 0.5% trailer fees and another distributor 0.4% trailer fees for the same retail share class, assuming the first distributor can provide a larger business to the fund provider. It is important to note that trailer fees have no impact to investors in regards to the fund performance, as long as we are comparing the same share classes, since the management fee for a fund share class is fixed, regardless if trailer fee is paid to any distributors. From an investor perspective, it is more crucial to assess whether you are able to subscribe to a cheaper share class, such as institutional share class, so that the management fees are lower and therefore the overall performance of the share class is higher. That being said, it is useful to understand what distributors receive in terms of fees, as the distributors obviously are incentivized to promote and recommend funds and share classes that give them trailer fees versus those that don't. Therefore, be prudent when you do your research and review on fund ideas from distributors. It is also useful to note that some distributors, especially newer online trading platforms, may opt to pass any trailer fees collected back to the investors in order to attract more business, effectively giving the investors an experience similar to investing in a cheaper share class. Performance fee is the second type of ongoing fees charged by a fund. As the name implies, performance fees are essentially additional fees rewarded to the fund manager for good performance. By good performance, this means the fund's performance has exceeded a predefined target level called hurdle, which is updated after each performance review period. Naturally, the calculations for every new performance period would start off with the high point of the previous period, and this approach is called high watermark. Performance fees are primarily used to encourage the fund manager to maintain a continuous good performance, instead of trying to take overly aggressive investment bets to do well in one period and suffer afterwards. Performance fees are also embedded within the fund NAV, though it is usually accrued for a period, for example, monthly or quarterly, before being adjusted from the NAV calculation. Performance fees are more common in hedge funds, but there are a small number of mutual funds that still include performance fees. This is uncommon in mutual funds because mutual funds are highly correlated with their associated benchmarks, and therefore it is unrealistic to expect a positive performance when the benchmark is going through a negative period. The mutual funds that have performance fees generally define their hurdles as a percentage of outperformance above the benchmark's performance, which in absolute terms may still be a negative return to investors in a bad year. Besides the management fee and performance fee, which are fees intended for the actual running and management of a fund and its portfolio of investments, the third type of ongoing fees are the other charges and expenses that the fund spends on. These are more generic administrative and operational expenses and include costs such as legal and auditing charges, brokerage transactional fees, governmental duties and charges, registration costs, expenses incurred in the notification and publication of information and materials to investors and other public platforms, and so on. Given these can be varied and miscellaneous, the costs involved are not fixed and usually not very clearly defined in value. However, this is typically around 0.1% to 0.5% worth of NAV yearly. Many of these costs are flat value expenses, meaning they are not affected by the fund size. For example, the auditing firm will likely charge the same auditing cost to a fund provider regardless if the funds are $100 million or $1 billion in size. Therefore, to investors, a larger fund size will help to reduce these miscellaneous costs in percentage terms. Conversely, if the fund size shrinks, these costs will increase in percentage terms. This is also why when a fund shrinks down to a very small size, these costs to maintain the running of the fund become too expensive for both the fund provider and the investors, and therefore the fund provider will eventually terminate the fund. Summing up the management fees and the performance fees, if any, and other expenses gives a percentage value that is termed total charges or ongoing charges or total expense ratio, which is also known as TER. Some mutual funds indicate the management fees in their fact sheets, while others indicate the TER instead. Few funds indicate both. This makes it a bit troublesome when we try to compare the fees of different funds. But unfortunately, this aspect is not really standardized by the regulators. Similarly, some investors tend to focus only on management fees, while others look at TER to get a sense of how much fees they are indirectly paying the fund. Regardless which number is used, the principle of this is basically that the fund needs to deliver an average performance that is higher than this number, plus the benchmark's performance to make the investment worthwhile. For example, if the benchmark delivers 10% returns and the fund delivers 11% returns before fees but has a 1.5% TER, this means the fund manager can indeed outperform the benchmark slightly, but the cost to run the fund is higher than the outperformance, resulting in the investor getting only 9.5% returns, which is worse than the benchmark. The third category are one-time transactional fees for special or specific circumstances, with the most commonly seen being early redemption penalty or early redemption charges. This is frequently confused with CDSC, but is actually quite different. Some fund strategies require investors to stay invested in the fund for a certain time period to achieve a more practical expected return. If some investors opt to redeem early, it forces the fund to sell off some holdings before their intended value gain is achieved. This negatively impacts the whole portfolio and the remaining investors. One type of mutual fund, called Fixed Maturity Product or FMP, has exactly this characteristic. An FMP is designed to invest in a portfolio of bonds and hold them for a fixed number of years, with the intention of having all the bonds mature by the end of that time period and the fund will terminate thereafter and return all proceeds to investors. Assuming no defaults happen throughout the time period, the returns of the fund can be quite accurately calculated at the start of the FMP, as there are no major adjustments expected in the portfolio, and the underlying are bonds to be held till maturity. A key risk of an FMP, therefore, is that some investors may redeem the fund before the end of the time period, forcing the fund to exit some of the bond holdings to convert to cash to facilitate the redemptions. The intended returns of the fund are then disrupted as the portfolio has been adjusted, and therefore, the remaining investors are negatively impacted. As these funds still want to offer a normal mutual funds liquidity, it is not practical for them to stop redemptions completely. Hence, they have to implement a way to disincentivize investors to early redeem. The result is that the fund remains open and liquid, but implements an early redemption penalty fee. The early redemption penalty fee basically charges a redemption fee for any early redemptions and can be tiered based on the time period like a CDSC. However, this early redemption fee is not collected by the distributor or the fund manager, but is instead allocated back into the fund to help reduce or negate any negative impact caused by the redemptions. Do note that the early redemption penalties are stopgap measures and not a perfect solution. If an FMP has massive redemptions, it will still collapse, as the remaining portfolio will not be able to deliver the intended returns anymore. Switching fees are another type of one-time situational transaction fee that you may encounter. For mutual funds, there are two types of switching that is possible. The first type is switching share classes within the same sub-fund, with the most common scenario being an investor wanting to switch from an accumulation share class to a distribution share class for income reasons. Switching between currency share classes is more complicated due to FX conversions needed, and so many funds do not allow for it. Switching between investor type share class is also not permissible, unless the fee structures are similar. The second type is switching sub-funds within the same fund family. This is less commonly seen and not allowed by some fund providers. The exception is during the termination of a sub-fund, whereby the fund provider will ask the investors of that sub-fund to switch into another sub-fund within the same fund family in attempt to retain the invested monies. Switching fees are less common today. Fund providers will typically not charge a switching fee themselves, but specify a switching fee in the fund prospectus, for example, stating as up to 1%, to allow distributors to charge as needed. Therefore, remember to check with your bank or online investment platform before going ahead with a switch request. Last but not least, there are rare occasions where you may encounter fees being charged to you indirectly or not done in a straightforward manner. For example, a distributor may work with a fund provider to launch an exclusive fund share class that waives off subscription fees at launch, but indicate that the starting NAV of the fund share class will be 2% lower at the end of the first day of launch. This 2% difference may be paid by the fund provider to the distributor at the back end. While it is not worded as a subscription fee, the end result is the same, whereby the investor has lost 2% of the investment on day one. As such, do be prudent when being marketed on an investment that looks too good to be true. While fund fact sheets generally provide some basic fee information, the contents are not consistent across fund providers, so it may be difficult to compare fees between funds using fund fact sheets. For all authorized and recognized mutual funds offered in Singapore to retail investors, the MAS mandates the fund providers to create a Product Highlights Sheet, or PHS document, based on a standardized template. The PHS is very useful for finding out the basic fee information of a fund. The screenshot example here is based on the Schroder Asian Equity Yield Fund. The total expense ratio, or TER, is clearly specified at the top for the retail A share class here. You will see small differences between the currency share classes, which is due to hedging costs, and small differences in other expenses. The fees and charges section splits clearly into two parts. The first part are fees payable directly by investor, which means it is separate from the investment amount. Here you can see the initial charge, or subscription fee, is up to 5%. This again is collected by the distributor, so different distributors can charge differently for the same fund. Switching charge is up to 1%, and in this case the fund prospectus states it is for the distributor as well. Redemption charge is none. Therefore, distributors are not allowed to charge a redemption fee for this A share class. The second part are fees payable by the fund from invested proceeds, which basically means they are the ongoing fees embedded within the NAV calculation. Here you can see the management fee for A share class is 1.5%, and it further breaks down and states that up to 65% of the management fee can potentially be paid to distributors as trailer fee. Performance fee is not applicable for this fund. The rest of the fees, such as custody fee, administration fee, and below, are what we consider as other expenses. As previously mentioned, these are not fixed, so the fund provider can at best give an up to number for guidance. Again, the PHS is very useful to find out this fee information. However, if you would like to check and compare the fees of different share classes of a fund, you will need to go through the fund prospectus instead, as the PHS will not cover share classes not intended for retail investors. Similarly, restricted funds do not have PHS, and you will need to refer to the fund prospectus for the fee details as well. Now, we have covered quite a lot on mutual fund fees. However, it is important to note that comparing fees alone between funds is not a good method to pick a fund to invest. Ultimately, you will need to look at the expected returns net of fees. For example, if we have a fund A that charges a 2% TER but can deliver 10% net returns, and another fund B that charges a 1% TER but can deliver only 5% net returns, Fund A will still be the better choice as the eventual returns are higher. This is the same logic as shopping for most other things, where we will pay more for a product that gives superior value. Therefore, cheapest is usually not the best option. We will cover the different aspects to consider when selecting funds in another video next time. Hopefully this video has given you a better overview and understanding of the different types of mutual fund fees that are being charged directly or indirectly to investors. This concludes this video. Do check out my other videos to find out and learn more about mutual funds. If you find this video useful and would like to see more related contents, please click on like and subscribe to the channel, as well as share this video to someone else that might find this useful too. Last but not least, if you spot any mistakes or inaccurate information in this video, or have any suggestions to help improve this video, please do drop a comment below. Thank you and have a great day.